The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students too can take advantage of in-person opportunities by taking tours.
Hey, ¿cómo estamos, mis amigos y amigas? Llegó el momento, la hora. Ya muy pronto estará comenzando y saldrá nuestro tío Jerome. Antes de todo, espero que estén pasando un increíble. Estamos hoy ya por fin 27 de julio y vamos esperando qué es lo que nos dice. ¿Será que se va a ir 0.75, 1% completo o será que será algo blando? En esta transmisión estaré pasándola completamente, ¿ok? Pero no voy a traducir hasta el final de la transmisión. Y esto es para poner atención. Realmente vamos aquí a estar apuntando y viendo ciertos puntos que también al final estaré haciendo un video y publicándolo en nuestro otro canal. Pero para que sepan que no voy a estar traduciendo entre medio que él esté hablando. Y uno de estos es porque en realidad me gusta poner atención qué es lo que él proyecta, cómo habla. Y todo eso lo estaré diciendo al final de la transmisión. Denle me gusta, compártenlo, alístense porque ya viene el tío Jerome, ¿ok? Espero que las pasen increíblemente. Ahí estemos listos. Vamos a estar al pendiente y anotar a salir. La transmisión posiblemente pueda tardar unos 15 a 20 minutos a que comience. Ahora, mientras se habla, puede ser hasta una hora. Entonces ahí agarren su cafecito. Espero que la pasen increíble. Denle me gusta y pues nos estamos viendo después que salga nuestro tío Jerome voy a estar hablando sobre los puntos, podemos decir, más fuertes que habló en esa reunión. Entonces, para los que a veces preguntan por qué no traduzco entre medio, es uno de esos motivos. Me gusta bien agarrar los puntos porque eso nos ayuda un poquito más a ver las proyecciones de lo que puede hacer en un futuro. Esperando que les guste, vamos ahí y sigamos esperando que salga nuestro tío Jerome. Nos vemos.
And also gather economic information from all over the country
to help the Fed both monitor the economy and get the broad input necessary
to develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions, all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy,
which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
by making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. Employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
¿Cómo estamos, amigos y amigas? Aquí nos encontramos esperando a la Fed. Ya no tarda en salir, ¿ok? El mercado se ve como que está con la duda, ¿ok? Ahora vamos a hablar sobre los diferentes escenarios realmente que vamos a estar esperando el día de hoy, ¿ok? Muchos piensan que la Fed pueda venir y pues subir 1% completamente. Yo creo que es muy difícil que eso pase. Yo creo que la Fed va a aplicar a 0.75. Tengo una encuesta en mi otro canal. Si no la han llenado, pues llénenla. Ahí estoy preguntando qué es lo que piensan que pueda pasar. Ahora yo estoy viendo 1.75 aproximadamente lo que va a subir la Fed. Pienso que el mercado le puede gustar esto. Tenemos que tener pues en contexto que pues pues mañana 28 recibiremos lo que es el GDP, y estos datos GDP pueden venir negativos y este ser el segundo cuarto en cual estamos negativos, y esto podemos decir que estamos en una recesión. Ahora hay mucho que pues muchos hablan y analizan sobre esto porque podamos estar en una diferente situación, ¿ok? Entonces vamos a estar también en la espera de esos números. El día de mañana va a ser muy importante lo que es hoy y mañana. Ahora sí, yo pienso que Jerome Powell va a salir firme, pero va a salir con un 1.75. Esperemos que sí. Espero que el mercado venga y esto lo obtenga y pueda hacer que estemos bien. Esto significa que están combatiendo la inflación, y esto son buenas noticias porque podamos al final de todo lo que es en un par de meses comenzar a ver que la inflación comienza a bajar. Yo creo que es algo que todos estamos esperando. Mientras estamos aquí conectados, vamos a saludar a todos los que se conectaron. Araceli López, un fuerte abrazo. RTM, Charlie Prado, ¿cómo estamos? Dilman David, Maggie Gómez, aquí estamos esperando. Alex Gómez, Peto Silva, Minis, Antrax, ¿cómo estamos? Gmail 1, ¿cómo estamos? Andrew Flores y Alexander, ¿cómo estamos el día de hoy? Espero que estemos bien. Aquí estamos reunidos esperando pacientemente. Como les comentaba, entre medio de la reunión sí voy a estar tomando apuntes. Entonces voy a hacer un video hablando sobre esos puntos que va a hablar Jerome Powell. Entonces estén ahí al pendiente al video también. Aunque también al final de lo que es la transmisión estaré dando un resumen de lo que él diga. Entonces, para todos los que quieren ver ciertos puntos, esperen hasta el final porque siempre estaré dando un pequeño resumen de lo que estoy viendo. Okay, estamos ahorita pacientemente. Aproximadamente nos queda unos 15 minutos más de espera. Todavía estén pacientes y ya comenzará esta reunión. Vamos a ver qué es lo que termina pasando. Ahora, lo que sí tenemos que ver es que la Fed ha sido muy buena en darnos señales, ¿ok? Y esto es algo donde yo hablo mucho sobre que la Fed es muy buena dando señales. Ahora, lo que fue la última vez cuando subieron a 0.75, sí nos dimos cuenta que vimos señales afuera que iban a subir a 0.75. Fue algo que pues nos dimos cuenta, comenzamos a ver las señales y pues eso terminó siéndose. Ahora, esta vez pues no vimos señales de 1% completo. Okay, no vimos nada que pues sea algo que viniera de una fuente muy fuerte que nos daría a entender que iban a subir a 1% completo. Yo creo que por eso la Bolsa de Valores no ha facturado un 1% completo, porque creo que no se ha escuchado ni un rumor fuerte que lo vayan a hacer así, sino que lo peor que podamos ver es 0.75. Ahora, habiendo dicho eso, estos son buenas noticias. Si dan 0.75, quiere decir que la Fed está trabajando fuerte para la inflación y que no van a dar vuelta atrás, pero a la misma vez podamos esperar que la inflación comience a bajar en ciertos momentos. Ahora recordémonos de algo que está sucediendo, y esto no es mentira. Ya las empresas están comenzando a venir y a hacer recortes laborales, ¿ok? Que esto pues no son buenas noticias, pero en una otra parte estamos viendo que la demanda está cayendo. Y esto son buenas noticias porque si comienza a caer la demanda, que estas empresas ya no están produciendo lo mismo, pues vamos a ver ya que comenzamos a contraernos y que la inflación comience a bajar. Y estas son unas buenas noticias, que sí que los intereses está funcionando. Entonces, habiendo dicho eso, es muy posible que esto reafirme que la Fed sigue trabajando para bajar la inflación, y si hacen 0.75 nos vamos a dar cuenta que al final de todo va a funcionar, ¿ok? Ahora, como les decía yo, ya nos están dando señales las empresas que está funcionando. Ya quiera o no, ya no están reportando tan fuertes. Están diciendo que los consumidores ahora se están enfocando en lo que son artículos diarios, artículos que necesitan, y ya se están moviendo un poco a no comprar lo que no necesitan, ¿ok? Y esto es algo que pues nos estamos dando cuenta. Entonces esperemos a ver qué es lo que termina pasando con Jerome Powell. Les mando un fuerte saludo a todos los que están aquí. Dice Mongacua 2008. Saludos Marvin y a todos los presentes en el chat. un feliz día. Espero que estén bien. ¿Qué opinan? Coméntenme en el chat. ¿Piensan que van a subir a 0.75 o a 1% completo? Ahí compartan lo que piensen, qué es lo que piensan que pueda pasar. Yo en lo personal voy a 0.75 y espero que nos dé señales que podamos ver en las siguientes reuniones 0.50. Yo creo que si recibimos 0.50 en las últimas 2 reuniones creo que quedan, pues sería muy bien y creo que el mercado le gustaría eso. Entonces coméntenme ahí qué es lo que piensan. Seguimos aquí en la espera. La bolsa de valores de una u otra manera está, podemos decir, estable ahorita. Sabemos que pues sí, quiera o no, ha sido una semana crucial, ha sido una semana roja, en cual sí lo he esperado así. Yo creo que habíamos preparado una semana roja por lo mismo, ¿ok? Pero no todo lo que a veces uno piensa que es malo. Y como yo decía, ciertas empresas ya están reportando, pues están reportando los resultados de la alta de intereses. Y eso es que ya personas no están gastando mucho y están reduciendo en ganancias. Y esto nos estamos dando cuenta. Entonces yo siento que al final de todo podamos ver una disminución de lo que es la inflación. Tal vez no este reporte que lo van a dar ahorita en agosto, pero podamos ver una reducción en septiembre. Esto es lo que yo pienso. Entonces puede ser que todavía veamos un reporte alto en agosto, pero septiembre puede estar un poquito más aliviado. Ahora recordémonos algo, ¿qué es lo que pasa? Es igual, todo eso pasa igual en todo. Que el reporte de lo que le llaman el CPI, el que mide la inflación, lo mide un mes anterior. En pocas palabras, el que recibimos en julio, vimos lo de junio. Ok, entonces lo que realmente veamos en agosto va a ser lo de julio. Entonces por eso siento que podamos ver algo un poquito más, un alivio a la inflación, lo que estemos viviendo ahorita en agosto, lo que estará reportándose en septiembre. Entonces por eso pienso que pueda ser un poquito mejor ya en ese tiempo, en esa época. Y vamos a estar ahí al pendiente. Un fuerte abrazo. Aquí quien lo dice, Maggie dice 0.75. Aida Bellino dice sí a 0.75 y súper abajo las casas ya están bajando, ya tienen que equilibrarse y eso es muy cierto. Las propiedades, yo he estado haciendo unos videos en mi otro canal donde pues muestro, ustedes saben, yo soy realtor para Century 21 y ya estamos viendo un retroceso de las propiedades. Las propiedades ya no se están yendo tan caras, tan costosas como se iban. Ya estamos viendo que ciertas propiedades incluso ya están haciendo algo que no hacían. Y estos son señales que sí está funcionando la alza en los intereses. Y esas señales es que las propiedades no les hacían reducción de precio. Ahora, si vemos en el mercado, muchas ya tienen reducción de precio, ya no se están yendo al precio que querían, ya se están yendo a reducciones y esto nos dice que pues sí está dando vuelta. Ahora, había algo que había platicado que me habían dicho, ¿tú crees que pueda caer como cayó en el 2008? ¿Ok? Y esta es una muy buena pregunta porque me han preguntado, porque me dicen, no, si cae así como el 2008, ¿para qué voy a comprar ahorita? Mejor espero. Ahora, yo en lo personal, yo les voy a ser sincero. Yo siento que caiga así como el 2008 es muy difícil, ¿ok? Y es lo que les digo a veces sobre estos reportes del CPI, que estamos en recesión. Mucho esto, pues todo lo que son, podemos decir, todo es dependiendo de las circunstancias y a veces hay circunstancias muy diferentes a otras. Aunque los datos puedan irse a ver que sí pueda caer en el 2008, pues las circunstancias en el 2008 eran muy diferentes a las circunstancias que tenemos en este momento. Y una de esas circunstancias es en el 2008 cualquier persona podía venir y obtener un crédito bancario para propiedades. Y eso era así, era bastante fácil tener un crédito. En realidad que era bien pequeño o mínimo, si lo podemos decir en mejores palabras, mínimo lo que los bancos pedían para aprobar para un crédito hipotecario. No pedían mucho. Ahora es muy diferente ahora hacerlo. Agarrar un crédito hipotecario cuesta más, piden mucho más. Ahora ese factor, pongámosle ahí, es uno. Y en ese factor va que antes uno podía calificar para un préstamo bancario con lo que es, podemos decir, con un crédito de 520 puntos. ¿Ok? Un crédito de 520 puntos o menos todavía podía uno calificar por propiedades. Ahora ya no. Ahora el mínimo está entre los 620 puntos. Entonces estamos hablando de 100 puntos de diferencia. Eso es mucho, ¿ok? Y eso era la diferencia entre el 2008 ahora, ¿ok? Esa es una. Otra gran diferencia era que en ese tiempo había, por lo mismo, había mucho lo que le llamaban intereses variables, ¿ok? Entonces las personas venían y agarraban propiedades en intereses variables, y eso significa que les podía variar la tasa de interés dependiendo, ¿ok? Si subían los intereses, así como ahorita lo que está haciendo Banco Federal. Si uno tiene una tasa variable, que lo que significa esto, uno paga más intereses si el Banco Federal sube los intereses, y eso es lo que pasaba. En ese tiempo había, si no estoy mal, casi un 45% o un poco más de personas que tenían estas hipotecas con intereses variables. Entonces cuando la Fed comenzó a subir los intereses, pues también comenzaron a subir las hipotecas, y personas pues dejaron de pues poder pagar las hipotecas. Entonces ahora creo que estamos muy por debajo de los intereses variables. Muchas de las personas que adquirieron ya propiedades después de eso se miraban a que pues venían y pues solo obtener lo que son intereses fijos. Entonces significa que no les afecta si bajan o suben los intereses. Entonces esos factores hacen que pues sea diferente la historia y tal vez no caiga como uno espera que caiga. Entonces lo que les comento era lo mismo que están hablando sobre la recesión. Mañana recibiremos lo que es el GDP. Y en el GDP, si es negativo, pues usualmente nos da señales que estamos en una recesión. Pero como muchos dicen, estamos en otro completamente, podemos decir, estamos en diferentes proporciones. Ahora tenemos tal vez posibles GDP negativos, pero tenemos 400,000 trabajos que se abren cada mes. Significa que hay aproximadamente, pues por cada persona hay 2 trabajos que necesitan pues completarse, llenarse, y esto hace que estemos en unas circunstancias muy diferentes. Entonces es algo que tenemos que tener en mente. Las circunstancias a veces son diferentes, y por eso es que tenemos que estar siempre bien informados. Denle me gusta, suscríbanse si no se han suscrito al canal. Lleguemos a los 1000 suscriptores. Estamos muy cerca de llegar a los 1000 suscriptores. Un fuerte abrazo a todos. Aquí estamos, dice Gabriel Estrada, dice saludos Marvin, buenos días a todos. Francisco Ortiz, ¿qué tal Marvin? ¿Alguna novedad de AMC? Ya muy pronto vamos a ver los earnings de AMC, tengo que verlos, vamos a ver cómo vienen. Yo espero que tengan unos buenos ingresos. Recordémonos que tuvieron varias películas hits, y esto pues trajo millones de dólares en el box office, y esto significa ingresos para los cines. Entonces vamos a estar ahí viendo qué es lo que termina pasando con AMC. Yo sí le veo muy buenos earnings, y eso es lo importante. Tenemos que entender que pues AMC es AMC, pero aparte ahora está haciendo algo bueno, que es recibiendo ingresos, y esto es bueno para cualquier empresa. Entonces vamos a ver qué es lo que termina pasando esos ingresos, que si fueron buenos los que fue el último cuarto, pues estos yo estoy con la esperanza que sean mucho mejor. A Yander Álvarez, saludos Marvin, Shiba to the moon. Todavía estamos ahí con Shiba, la paciencia termina pagando, eso es todo. Jesús Parra, hola Marvin, ¿cómo estamos? A todos los que están conectando. Aquí estamos en la espera, ya estamos yo creo que a unos 5 minutos de venir y pues ya estar aquí viendo la conferencia de Jerome Powell. Como yo les decía, yo no personal estoy esperando .75. Yo sí espero que el mercado le guste, que se agarre un poquito más de aire, ¿ok? Ahora recordémonos que pues de una u otra forma el Banco Federal, y lo ha dicho Jerome Powell, han hecho muy buen trabajo en que el mercado facture lo que viene. Y en pocas formas yo siento que sí se ha facturado lo que viene y pues podamos medir un punto 75. Yo creo que esto nos demostraría que la Fed está por sí en mano fuerte, pero tampoco no queriéndose exceder. Y exceder es hacer un Paul Walker. Esto es lo que le da miedo al mercado. Un Paul Walker, para los que tienen duda, okay, si no se han unido a nuestro club VIP, únanse porque ahí tenemos reuniones, platicamos y pues hablamos sobre ciertos puntos. Y ahí hablamos sobre lo que es un Paul Walker. Y un Paul Walker, para los que no saben, fue un presidente de la Fed, okay, ya de hace varios años, pero hizo algo en cual llevó, en pocas palabras, a Estados Unidos a una recesión. Y era porque en ese momento teníamos una inflación súper fuerte, el dólar se estaba desvalorando y pues estamos viviendo casi lo que estamos viviendo ahora con diferentes circunstancias. ¿Qué es lo que hizo Apple Walker? Vino y subió los intereses casi al nivel de la inflación. Entonces estamos dándonos cuenta que fue un golpe agresivo a la inflación y terminó, podemos decir, cayendo. Vivimos después de eso, después de la recesión, vivimos pues muchos años donde pues el dólar, pues ustedes saben la potencia que tenía, ¿verdad? Entonces tuvo efecto. Ahora sí esperamos que estemos en otras circunstancias y también esperamos que no sea necesario un Paul Walker, sino que solo sea necesario subir los intereses como lo están haciendo en este momento y al final de todo esté dando resultados. Espero que les esté gustando, suscríbanse al canal, lleguemos a los 1000 suscriptores, denle me gusta, compártanlo, ya estamos muy cerca de venir y entrar a esta reunión. Ya no tardará de ser, estamos aquí las 11:27 hora de aquí del Pacífico y sería las 12:30 hora del Eastern, que ya estamos a unos 3 minutos. Denle me gusta a todos los que están conectando. Recuérdense que no voy a estar traduciendo, sino que voy a estar tomando notas, ok, voy a estar tomando notas. Al final de lo que es la conferencia voy a hablar sobre los puntos que habló, los puntos que me llamó la atención. Y así mismo lo pueden ver al final de lo que es el en vivo. Ahí mismo estaré hablando sobre esos puntos. O si no, en mi otro canal, Marvin Martínez, van a poder ver un video que voy a estar haciendo especial sobre esta reunión y con los puntos que le veo. Y lo van a poder ver en otro canal también. Entonces, muchas gracias por su apoyo, okay. Ahí estamos siempre trayéndoles las informaciones en cuanto salen. Entonces vemos ahí, en unos 2 minutos comenzaremos. Entonces ahí estamos, un fuerte abrazo y alistémonos porque ya no tarda salir tío Jerome. Un fuerte abrazo a todos y gracias por la sintonía. Nos vemos en un par de minutos. Ya no tarda de comenzar, amigos y amigas, pero ya tenemos ciertos informes. Sabemos que hay fuentes informativas que tienen la información antes. Entonces sabemos aquí la Fed sube las tasas de intereses en 0.75 porcentuales por segunda vez consecutiva para combatir la inflación. Ya sabemos que lo subió. Vamos a ver aquí qué nos dice, pero 0.75 es que esto no es muy malo, muy bien.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point, and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from The Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5, and then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see. And we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations, and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings. and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina.
Hi, Jarrell. Thanks for taking our questions. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level, ultimately, at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have two questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that. But that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do. And we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, you know, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. GDP tomorrow? Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that.
Mis amigos y amigas, increíble, muy buenas preguntas para todos los que se están conectando. Denle me gusta, compártanlo. Al final de la conferencia estaré traduciendo. Muy buenas preguntas les están haciendo. Entonces, aquí tenemos ya nuestras notas. Quédense al final de la conferencia y seguimos aquí escuchando. Denle me gusta y muchas gracias por su sintonía.
The system is just now up and running, and I'm proud of what we did.
Hi, Katarina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates, and, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases, and now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully, and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about right now, there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end-of-the-year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter. But at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole. Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
How much weakness would you be willing to accept before you think about pausing rate cuts?
So I think we're going to be looking at inflation as well. We as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts. How do bank forecasts of possible recessions, economists? Does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event, given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment, as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. And I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time, it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. we're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation. But I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately, the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all those? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so that's really what accounts for the pace at which we moved. And, we did, when inflation changed direction really in October, we've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month, and, we kind of thought we we had the story, probably had the story right, but then I think in October you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. You know, we're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession and that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, you know, if you think about what a recession really is, it's a broad-based decline across many industries that you know, that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Thank you very much. Simon Rabinovich with The Economist. You've said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for, the negative slack we have in the economy by the over-tight labor market. So if you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically. If the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now, and I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. Going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. For a financial stability perspective, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have from a financial stability standpoint, you have a pretty decent picture. Now, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, we think of that as things that might undermine the working of the financial system, so big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that in many cases their paycheck doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption, and it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to, we don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
¿Cómo estamos? Aquí estamos. Terminó la conferencia. Tío Jerome vino y nos habló sobre ciertos puntos. Ahorita vamos a estar hablando sobre los puntos que tenemos que tener presentes. Okay. El primer punto que todos estamos esperando es que no viniera y no sobresubiera la inflación. Quedó en 0.75, ¿okay? De una u otra palabra, era lo que se esperaba del mercado. Yo en lo personal había dicho que pues el mercado no había facturado 1% completo, y si en realidad miramos un 1% completo, podía sacudir un poco al mercado, y al final de todo no fue así, ¿ok? 0.75. Ahora, habló sobre ciertos puntos, pero uno de los puntos más importantes es que no nos dio tanta seguridad de lo que pueda hacer en las siguientes reuniones. Es posible que incluso encontremos un 0.75 en la siguiente reunión. No vino y dijo que no era posible que eso pasara. Entonces, todo depende de los datos. Van a estar muy, pero muy cuidadosos a los datos. Entonces, vamos a estar muy, podemos decir, esperando el CPI. Ahora, algo que nos habló que a mí me interesa mucho es porque primero sabemos que mañana vamos a recibir lo que es el GDP. Si viene negativo, pues podemos decir que es una forma en cual podríamos estar en una recesión. Ahora, yo hice un video, si no lo han visto, vean mi video que hice en mi otro canal, donde hablaba que no precisamente si venía un número negativo el GDP, pues podría decir que sí estamos en una recesión. Y esa pregunta se le hicieron a Jerome Powell, se le hicieron. Y lo primero que dijo es que usualmente los primeros números que vienen del GDP pueden no estar completamente, podemos decir, al 100. Entonces puede ser que no, si dice que sí estamos negativos, puede ser que no estemos en una recesión, aunque vamos a ver las noticias que vamos a tener una recesión. Pero él primero le preguntaron si él creía que estábamos en una recesión en este momento, y él dijo que no, que él siente que no estamos en una recesión. Ahora sí dijo sobre que pues en un futuro cada vez se está haciendo, podemos decir, la travesía de poder salir de esto sin entrar a una recesión cada vez se está minimizando. En pocas palabras está diciendo que la travesía para entrar a esa puerta cada vez está haciéndose más pequeña para poder salir de esto, lo que estamos en este momento, sin entrar en una recesión. Pero él pensaba que no estábamos en una recesión. Y esto es algo que yo hablaba. Es porque estamos completamente muy diferentes. Estamos en otros escenarios, ¿ok? A lo que realmente pues nos demuestra una recesión. Porque sí, ahorita ya comenzó la economía a contraerse y ciertas compañías están reportando que ya no tienen muchos ingresos. Pero como él dijo, de una u otra manera, el lado laboral estamos hablando que el desempleo estamos en lo más bajo en 50 años. Aproximadamente se producen 400,000 empleos cada mes. Entonces, en el lado laboral estamos viendo que hay una fuerza completa, y esto pues nos demuestra que pues sí, sería muy, pero muy difícil entrar a una recesión cuando tenemos un lado laboral bastante fuerte. Claro, se está contrayendo la economía, pero es porque la Fed está haciendo esto, está viniendo y subiendo los intereses, y esta es la idea, que haya una desaceleración a todo lo que está pasando, y esta es la única manera de venir y pues bajar la inflación. Pero eso no quiere decir que completamente ya estemos en una recesión o que vayamos a entrar, pero sí, tampoco nos dijo que no íbamos a entrar, sino que dijo que cada vez se estaba achiquitando la puerta. Pero sí, él pensaba que los pasos que estaba haciendo la Fed eran los necesarios para tratar de evitar esto, ¿ok? Ahora volvió a asesorar que su punto número 1 es que la inflación caiga, y esto por eso de una u otra manera están subiendo los intereses y los seguirán subiendo a como sea necesario. Ahora, algo también que dijo que es muy necesario que sepamos es que la Fed va a venir y subir los intereses acorde a los números que estén saliendo. Entonces, pues eso es muy necesario. Yo les decía a mis amigos y amigas que parte de ser un inversionista es estar informados, ¿ok? Y esto siempre lo he dicho porque en realidad que pues todo puede cambiar a cuestiones a lo que esté pasando alrededor. Entonces, una de las cosas que dijo que todas las decisiones que van a tomar van a ir acorde a las noticias que estén saliendo y los datos que estén saliendo, datos laborales, datos del CPI y todo, y esas decisiones las estarán tomando. Ahora recordémonos de algo, que la Fed también puede realmente subir muy fuerte los intereses al afectar los trabajos y al afectar también a las personas. Por eso es que lo están tratando de hacer bien, sin necesidad de entrar a una recesión, y eso es algo que me gustó. Yo siento que ahí agarró algo fuerza lo que es el mercado, cuando él dijo que pues sí, él quieren intentar no llegar a una recesión y no entrar a una recesión, y sí vamos a ver volatilidad, pero la idea no es botar el mercado. Y esto pues de una u otra manera creo que el mercado le gustó. Vimos una alza, ahora que siempre estará al pendiente. Yo creo que ahorita vamos a ver una volatilidad, pero sí era lo que se esperaba. El mercado le gusta, lo estamos viendo. La S&P 500 agarró un poco más de aire, 100 puntos. Y estas son buenas noticias, aunque hay que estar al pendiente de los números de mañana. Y no solo eso, recordémonos que aparte de los números de mañana vienen los earnings, o que estamos en unos earnings muy importantes. Ahora va a estar Meta, lo que es a finales de día de hoy, y vamos a tener lo que es mañana, vamos a tener Apple, vamos a tener Amazon. Entonces los earnings van a estar pues de una u otra manera, vamos a estar muy al pendientes. Ahora recuérdense que el efecto de lo que está haciendo la Fed ya lo estamos viendo, y esto era lo que quería la Fed. Okay, y ese el efecto, cuando digo el efecto, es que queremos ver que la economía desacelere. Iba muy rápido y necesitan que ponerle un freno, y estamos dando cuenta, ¿ok? Los consumidores están comprando menos, ahora ya se están enfocando en consumos básicos a lo que era antes, a lo que se compraba. Y esto pues venga y ayude a la inflación a comenzar a bajar. Entonces es muy posible que recibamos datos buenos, tal vez no pero tal vez en septiembre ya veamos unos datos buenos en el CPI, es lo que se espera. Yo en lo personal eso es lo que estoy esperando. Espero que les haya gustado lo que es en vivo, mis amigos y amigas. Les he extrañado a todos los que siempre están ahí al pendiente. Ya estoy a punto de irme a mi clase de sargento, entonces pues he estado pues no haciendo muchos en vivos, pero ya regresaremos una vez más. Únanse a nuestro club VIP, suscríbanse al canal. Si quieren ver estas notas, yo voy a estar haciendo un video de los puntos importantes para el otro canal, entonces vamos a echarle siempre para adelante. Recuérdense, suscríbanse a este canal, lleguemos a los 1000 suscriptores. Vamos a saludar rapidito aquí a los que se conectaron: Ingrimar, José Luis, John Gomero, ¿cómo estamos? Fuerte abrazo. Nelson Galvez, Araceli López, dice Marvin, a tu conocimiento, ¿estamos en una recesión o no? Yo en lo personal siento que no estamos en una recesión. Pienso igual que Jerome Powell, creo que estamos como les decía yo, estamos muy diferentes a diferentes etapas, ¿okay? Y no podemos comparar ciertas historias con otras. Creo que lo que nos está pasando ahorita son completamente diferentes eventos. Creo que el empleo es demasiado alto, creo que el desempleo es demasiado bajo para que pueda decir que estamos en una recesión, y en una otra parte siempre veo fuerza en la economía, y por eso hay ciertas empresas que a mí me están gustando, que yo ya me estoy llenando, ¿ok? Ahora siempre analicen y estudien, recuerden que es solo de entretenimiento, pero yo sí veo alguna fuerza. Vamos a ver aquí, Ingrimar, exactamente, Exxon, Liguismon, hola, saben de Spotify, estaba en alza. Sandro Flores, buen sus saludos. Un fuerte abrazo a todos los que se conectaron. Recuérdense, lleguemos a los 1000 suscriptores en este canal, amigos y amigas. Compartan el video. Espero que les haya gustado el resumen. Y como siempre, nos estamos viendo en la próxima. Recuerden que no hay nada imposible. Que todo lo pueden decir, se lo proponen, nos estamos viendo, ¿ok? Y el resumen de esto va a estar en el otro canal en unos 20 minutitos. Estaré subiendo. Un fuerte abrazo y gracias por su sintonía. Nos vemos y se me cuidan. Bye bye. Hasta la próxima. Se me cuidan a todos. Vámonos.